Gold just experienced its worst single-day crash in over a decade, plunging 6.3% and wiping out $300 per ounce in a matter of hours. After hitting an all-time high above $4,400 just yesterday, the gold market suffered a brutal correction that caught even seasoned traders off guard. But here's what most people are missing. This might not be the disaster it appears to be. Stay tuned because I'm going to break it down exactly what caused this historic sell-off, why it happened now, and most importantly, what happens next for your gold investments. What's up, everyone? Welcome back to the channel. I'm your host, Ali, and I've been following the gold market for a long time. Today was absolutely wild. Gold dropped from $4,300 down to just over $4,000, the steepest decline since April 2013. Silver got hammered even worse, falling nearly 9%. And if you're holding gold positions or thinking about buying the dip, you need to understand what just happened because this correction tells us a lot about where the market is headed. In this video, I'm going to give you the complete breakdown of today's gold crash. We'll cover four main catalysts that triggered the sell-off, the technical indicators that were screaming warning signs, and whether the fundamentals that drove gold up 60% this year are still intact. By the end, you'll know exactly what to watch out for and how to position yourself for what comes in next. Let's dive right in. Key point number one, the record rally that set up the crash. Before we talk about the crash, we need to understand just how overextended gold had become. This wasn't a normal pullback. This was a correction that had been building for weeks. Gold has been on an absolute tear in 2025. We're talking about 60% gains year to date, with gold rallying for 9 consecutive weeks before today. The metal hit all-time high, as everybody knows. And yesterday, it got to the highest point at around $4,400, up from around $2,700 at the start of this year. That's nearly a $2,000 move in less than 10 months. But here's where it gets interesting. When you look at the technical indicators, gold was flashing the most extreme overbought signals we've seen in 4 decades. The RSI, the Relative Strength Index, hit 89.72 on monthly charts. For context, anything above 70 is considered overbought, and gold was nearly at 90. That's the highest reading since 1980, back during the last major gold mania. Multiple technical analysts have been warning that gold was in what they call a parabolic territory, meaning that the price was rising too fast to be sustainable. Every time gold tried to break above $4,400 over the past week, it hit resistance and fell back. That's a classic sign that buyers are exhausted and sellers are waiting to take profits. And that profit taking is exactly what happened today. After 60% rally, institutional traders, hedge funds, and even retail investors decided it was time to lock in gains. When you have that much profit on the table and technical indicators screaming caution, it doesn't take much to trigger a cascade of selling. One major fund starts selling, algorithms kick in, stop losses get triggered, and suddenly you have a $300 drop in a single session. The lesson here is simple. No asset can go straight up forever. Gold definitely needed to cool off, and today was that reset. Key point number 2. CME margin hikes and forced liquidations. Now, profit taking alone doesn't explain 6.3% crash. What really amplified today's sell-off was forced liquidations triggered by margin requirement increases at the Chicago Mercantile Exchange, the CME group. Here's how this works. When you trade gold futures, you don't need to put up the full value of the contract. Instead, you post margin, essentially a security deposit. The CME sets these margin requirements based on volatility and risk. When prices get too volatile or move too fast, the CME raises the margin requirements to protect the system from excessive leverage. And that's exactly what happened today. The CME sent out a letter on October 9th, and they said that they're raising the requirements by approximately 5.8% mid-October, following a similar increase earlier in October. This means traders who were using leverage suddenly had to post more collateral to keep their positions opened. And for traders who couldn't or wouldn't meet these higher margin calls, the only option was to sell. And when you have a lot of leverage positions being unwound at the same time, it creates what we call a margin cascade, where selling begets more selling, which triggers stop losses, which forces more liquidations, and price plummets. So one of the precious metals analysts, Dave Erfel, explained it perfectly. He said, and I quote, CME is saying, we got to calm this down, and that's exactly what happened today. We had a $300 reversal in gold, end quote. What made this worse was the timing. Gold volatility spiked to a 5-year high, and which is a 1-month implied volatility of 30%, which is 4 standard deviations above the long-term average. When you combine record volatility and margin hikes, you get explosive moves to the downside. Silver was even more dramatic because the silver market had been in backwardation, where spot prices are higher than future prices, indicating extreme tightness. Regulators were getting nervous, and when they crack down, traders bail out fast. That's why silver dropped nearly 9% compared to gold 6%. The key takeaway here is this wasn't necessarily organic selling based on fundamentals. A significant portion of today's drop was mechanical, forced liquidation due to exchange rules. That's actually somewhat bullish long-term because it means the correction wasn't driven by investors losing faith in gold prospects. Key point number 3 is the geopolitical shifts. While technical factors and margin calls drove the mechanics of the sell-off, there was another fundamental catalyst that shifted sentiment, the U.S.-China trade optimism. President Trump announced yesterday that he expects to reach a fantastic deal with the Chinese president in their upcoming meeting in South Korea, which is scheduled for early November. Trump was quoted saying, "I think we're going to end up having a fantastic deal with China. It's going to be a great trade deal. It's going to be fantastic for both countries." Now, I know what you're thinking. We've heard this before. But markets react to sentiment and headlines, not just reality. The more prospect of easing trade tensions reduced demand for safe haven assets like gold. Think about what's driven gold higher this year. Geopolitical uncertainty, trade wars, conflicts in the Middle East, tensions between major powers, these have been huge catalysts. Investors buy gold when they are scared. When that fear subsides, even temporarily, gold loses one of its key supporting pillars. Jim Wyckoff from Kitco Metals put it in this way, quote, "Better risk appetite in the general marketplace early this week is bearish for safe haven metals. Essentially, when investors feel more confident about global stability, they rotate out of defensive assets like gold and into riskier assets like stocks." Adding to this shift was a strong US dollar, or stronger. The dollar index rose 0.4% to around 99, driven by expectations of continued expansionary policy from Japan's new prime minister. A stronger dollar makes gold more expensive for international buyers, which reduces demand. Now, here's my take. This geopolitical optimism might be premature. Trade negotiations are complex, and Trump has already been threatening things like triple digits tariffs, like 155% on China if the talks fail. The fundamental uncertainties that have supported gold, persistent inflation, massive government debt, Federal Reserve rate cuts, haven't gone away. And in the short term, sentiment matters, and today's sentiment shifted from fear to cautious optimism. That shift, combined with the technical exhaustion and margin pressures, created the perfect storm for a major correction. Key point number 4, what happens next? So the million-dollar question, is this the end of the gold bull market or just a healthy correction? I'm going to answer this with the bear case and the bull case, and then my honest assessment. Let's start with the bear case. The gold has rallied too far and too fast. The correction could deepen to $3,800 or maybe $3,600, which are the next major support levels. If the US-China trade deal actually happens and global tensions ease, gold could lose its safe haven premium. The Federal Reserve might pause rate cuts if inflation remains stubborn, which would support the dollar and pressure gold. Technical damage has been done, and momentum traders who drove prices higher will now amplify the downside. Now let's talk about the bull case. Despite today's 6% drop, gold is still up 54% year to date, one of the best performing assets of this year. The fundamental drivers haven't changed. Central banks continue buying at record highs, over 1,000 tons annually for 3 consecutive years. China, Poland, India, and Turkey are all accumulating gold as part of a broader de-dollarization trend. That's structural demand that doesn't disappear because of one bad day. Inflation remains above the Fed's 2% target, and we're getting delayed CPI data this Friday that could show prices are still sticky. The Federal Reserve is expected to cut rates again in October, which is typically bullish for gold because it reduces the opportunity cost of holding non-yielding assets. Global debt levels are historically high. With the U.S. government running trillion-dollar deficits, geopolitical risks haven't disappeared. They've just been temporarily overshadowed by trade talk headlines. And perhaps more importantly, ETF inflows have been massive. $64 billion year to date, with $17 billion in September alone. That's real capital flowing into gold, not just speculative positioning. And finally, the Standard Chartered called today's move a technical correction rather than a fundamental breakdown. Citigroup downgraded gold from overweight, but still forecasted consolidation around $4,000, not a collapse. And we had the Sevens report research said this is just a minor setback in a broader bull market. That's the bull case. Now, my assessment, I think this is a healthy correction and not the end of the bull run. Was it painful? Absolutely. Could we see more downside to 3,800 or 3,900? Definitely possible. But the macro backdrop, central bank buying, inflation concerns, geopolitical uncertainty, and currency debasement, those factors are still forces in play. What I'm watching closely is the Friday CPI data and the Fed's rate decision on October 28th. If inflation comes in hot and the Fed cuts rates, that's rocket fuel for gold once this technical washout is complete. If we get a risk-off event, whether geopolitical or economic, gold would likely resume its uptrend quickly. For traders, this might be an opportunity to buy the dip around 4,000 or slightly lower. For long-term holders, I wouldn't panic, and I'm a long-term holder. Gold has had multiple 5 to 8% corrections during this bull run, and each time it's recovered to new highs. The key is to separate noise from signal. Today's crash was largely technical, profit-taking, margin calls, and sentiment shifts. The fundamental case for gold remains ultra strong. Don't let one brutal day shake you out of a multi-year trend. Now I want to hear from you. Did you get caught in today's sell-off? I know I did. Are you buying the dip, or do you think gold's headed lower? Drop your comments below. I read every single one, and I'll respond as soon as possible. If you found this analysis valuable, smash the like button and subscribe to the channel. We will cover more about gold as more news comes up, and we help you navigate these volatile markets. Hit the notification bell so you don't miss any of the next videos. And let's talk about CPI data on Friday as soon as it comes out. Thanks for watching, and remember, corrections are part of every bull market. The traders who survive aren't ones who panic. They're the ones who understand what's driving the prices and position themselves accordingly. Gold may have crashed today, but the story is far from over. So stay disciplined, stay informed, stay diversified, and I'll catch you in the next video.